Right, you're welcome to this ACCA mock debrief for the SBR exam. For those going to sit for the December 2025, and I'll be taking you through a debrief of 2 questions in particular. They are of interest because the standards that are being examined at the moment, the sequence at which they are being examined, requires that we also take note and specifics regarding those that we hope will be examined for the December sitting. Not to say that we are preempting the December 2025 exam, but for purposes of ensuring that we are at par with our content, I chose this AMBER question that's specifically going to be dealing with leases. And so without taking so much time, I will start off with this, and then after this question, we're also going to do a question on groups. That will be question 1 in our examination. The SBR exam, as we all know it, consists of 4 questions. They are not complicated. It's mainly background knowledge that we shall use from our financial reporting exam or earlier studies that we did. So we don't expect to find so many complications as we do these numbers. So I think that will do for introduction. My name is Martin Mugwanya. I tutor SBR at MAT Abacus, Uganda, and I'll be your host for this session. All right, so the AMBER question. AMBER is a manufacturing company. It prepares its financial statements in accordance with IFRS standards. Its financial year end is 31st December 2027. So we have exhibits here as it will appear. So for those of you who are new to this platform, this is how the examination will be. You'll have your exhibits on the left-hand side and the requirements as well. And as you read for the exam, as you are doing your exam, when the time comes, just make sure that you don't read information that is unnecessary. And by this I mean, when you look at the questions, the way they are going to be structured, specific questions will be answered based on the exhibit. So you need to know where the exhibits are, and you need to know what information you require to do the exam. So this first information over which I'm hovering my cursor will be important. It's just trying to preempt what will come in the different exhibits. So the first one is saying the warehouses and insurance claim. That will be the first exhibit. So any question regarding the warehouses and the insurance claim will basically refer to that first exhibit. The second exhibit will be talking about the lease of a building. So you find a question on leases, know which exhibit to open at what time. And then the purchase of machinery will be the third exhibit. And so right now I think we can proceed to our requirements and see what is required of us. So on your screen, I hope you can see the exhibits, the requirements. The first requirement, as you can see, is asking us to use Exhibit 1. So using Exhibit 1, explain how the warehouses should be accounted for in the financial statements for the year ended 31st December 20X7 and 20X8. Notice that they're asking us to explain how we are going to account. And they are asking for an explanation for 2 year ends. The first one is 31st December 20X7 and 31st December 20X8. And then the second requirement asks us to explain how the insurance claim should be treated in the financial statements for the year ended 31st December 20X7. Okay, so from the introduction, we all know that based on the exhibits that were on our left-hand side, we knew the first one was mainly talking about the warehouses. Second one was on the insurance claim. And then the final one was on the purchase of machinery. So for the first requirement, we're going to use Exhibit 1 to explain how we account for the warehouses. And then Exhibit 2 will come in when we're explaining the insurance claim. Then the second requirement is saying using Exhibit 2. So we shall only have Exhibit 2 when we come to this requirement. It's asking us to explain the lease of the building and then explain how the correct application of IFRS 16, which I hope people are a bit conversant with at the moment. IFRS 16 talks about leases. And so we have to evaluate how the correct application of leases in this company's financial statements will impact the gearing. So of course, if they are asking us how it will impact the gearing, the assumption is we know how to calculate gearing and then provide explanations, the movements in the gearing. Then finally, using Exhibit 3, explain how the purchase of machinery in exchange for Amber's equity shares should be accounted for in the financial statements. So meaning this company is going to purchase machinery, and in exchange, they are not going to settle this transaction using cash. They're going to settle it using equity. All right, so at this moment, we can kick off our session. All right, so now I'll demonstrate how you are expected to maneuver through this spreadsheet based on the requirements that we have seen. So now we know that these are our requirements, and we are going to open our word processor, where we're going to ensure we copy and paste those requirements. Now, the beautiful thing about this ACCA platform is that it allows us to copy and paste. So now after copying and pasting, I definitely now no longer need that requirement tab. So now all my requirements are in the word processor, and that's where I'm going to put all my answers. So in the exam, I would advise that as a student tries to answer the questions, you first copy the requirements and put them in the word processor like I have done, and then we start answering the questions. Okay, so now the first question will be awarded 9 marks, as it's very visible to everyone. So we have to split our marks. Under normal circumstances, by default, you might think maybe they'll award the marks 4.5 and 4.5, although sometimes that's not the case. So, but let's assume it's 4.5 for the first requirement, the one that I am highlighting, and then 4.5 for the second one. So since we're using Exhibit 1, I'm also just opening Exhibit 1, because that's all I require to answer that first requirement. Okay, so here we go. All right, so we are going to answer it side by side. So I'm just hoping the information is clear in these exhibits. And then my requirements here on the side. All right. So here is the warehouse. We want to explain how we are going to account for the warehouse in December 20X7. That's the first one. And in December 20X8. Okay. So for December, so I could just begin and say December 20X7, that will be the first one, and then December 20X8. So if they are giving us 4.5 for that first requirement in total, that means I will probably get 2 marks there and get 3, or get 2 marks and 2.5 there. So you don't really have to be accurate at determining how many marks will be given to each, especially when a split is required. So December X7, how are we accounting for our warehouse? Let's read through the exhibit and we see. So Amber holds its inventory in several warehouses throughout the country in which it operates. The warehouses had been constructed at a cost of 38 million. So that's the cost of the warehouses. That's how much they cost. 38 million. Okay. So I could, okay. Could just try to expand that. So the cost of the warehouses is 38 million. So I could just summarize that information. Cost is 38 million. Okay, and were first used on 1st January 20X4. So 1st January 20X4 is when they were first used. So then the solution continues. Okay. Amber depreciate the warehouses over a 40-year period on a straight line basis. So these warehouses have 40 years useful life. Okay, on a straight line basis, so we can already calculate depreciation because it's on straight line. So over a two-day period, as we can see here, over a 2-day period, from 1st to 2nd January 20X8, the country suffered a severe storm. So a severe storm. Notice that we are dealing with a year end of 20X7. And they are saying over a day 2 period, 1st to 2nd January 20X8. That sounds like an event occurring after the reporting date because of those dates. And that's why dates are very important in this exam, because then now here we might be talking about events after the reporting period. So over that 2-day period, there was a storm. And the warehouses were inspected and found to be structurally damaged. Okay. So there was a storm. That sounds like an event of a reporting event after the reporting period. The warehouses were structurally damaged. That sounds like impairment. Sounds like impairment. With Amber's management assuming that this was wholly caused by the storm. Okay. However, when the warehouses were inspected by the insurance company on 20th January, it was found that they had previous structural damage which had been made worse by the storm. Okay, so the insurance company did their inspection on these buildings after the storm, and they are now trying to say that, yes, the damage was there caused by the storm, but the structure itself had initial issues before the storm. So the storm actually just aggravated the damage that occurred to the buildings. So as a result of the structural damage, Amber has decided to revise the remaining useful life of the warehouses to 11 years. Okay, now we can think of this. A company is allowed to revise the useful economic life. According to IAS 16, we can revise the useful economic life because that's subject to annual reviews. The useful economic life and the depreciation is subject to annual reviews. And we are allowed to review or change the useful economic life if either of these things happen. One, in case we hope to receive a smaller residual value on the sale of an asset, then that's an indicator that probably we overestimated the useful economic life of the asset. So that's one of the reasons why we might change the useful economic life. Because if, for example, at the initial stage when we bought this asset, we hoped to receive maybe a residual value of 10,000, then maybe 2 years down the road, we realize that, oh, we might actually not receive the 10,000 that we had assumed as our residual value. Then the reason why that could be happening is probably because we have estimated that maybe after the useful economic life of the asset, when we come to sell it, we shall not be recovering that money. So it's assumed that because the residual value has reduced from 10 maybe to 0 that we are hoping to get, it's assumed that we overestimated the useful economic life of the asset, and therefore we need to revise it down. Notice that the lesser period you use an asset for, the higher the residual value that you will get. So if I bought an asset today, and maybe it has a useful economic life of 10 years, and I sell it, let's say, I use it, let's say, for 3 years, and I get a residual value, and then someone else uses the same asset and sells it after 7 years, of course, we don't expect that both parties will get the same residual value, all other factors remaining constant, because the other party has used it for 7 years, I've only used it for 3 years. So me who has used it for 3 years, my residual value will definitely be higher than the person who has used it for 7 years. So in that essence, we expect that these people are revising the useful economic life. They're revising the useful economic life, which is correct according to IAS 16. They are revising it because of the damage. And now the damage that has occurred is an indicator that probably we shall not use, the structure will not stand up to the initially estimated useful life. It can now only serve us for a few years because of the damage that has occurred to it. So the damage is making us to revise the useful economic life because we don't hope to use it up to the end of its useful life. And also the residual value can be indicative. Although in this specific question, initially we estimated the residual value to be 0, so in this question it will not be applicable. But you might find in an examination that the useful economic life you initially estimated was 10,000, and now they are saying the useful economic life will be 5,000. So then that means we need to revise the economic useful life of that asset. So here they are saying that as a result of the structural damage, AMBA has decided to revise the useful economic life of the warehouses to 11 years, which is allowed, from 1st January 20X8 with a 0 residual value. The recoverable amount of the warehouses on 31st December 20X7 was estimated at 22 million. Now, as you read this question, a lot of things are going into your head. When I hear things like recoverable amount and I've seen indicators of impairment, I'm thinking I must say something about the impairment. So in 20X8, I have to say something about impairment. Okay, so how I will account for the warehouses. Impairment, something about IAS 37 has to be there, definitely. I have to say something about IAS 37. In the previous one, because this event is occurring after the reporting date, I know that this is IAS 10, events after reporting period. Okay, so there it is. Right, so when they give me the residual values and all that, I'm thinking about those two standards. All right, so AMBA has insurance which covers its building from general damage, but had chosen to not to insure against damage from natural disasters. Oh, so I'm thinking, if they are speaking of insurance, and let's see if we are going to receive these proceeds. AMBA has submitted a claim for all of the damage to the buildings and feels that the insurance company may pay compensation to cover all of the damages of 10 million out of good faith. Out of good faith sounds suspicious, because if we really have a claim to this money, we can't be speaking of good faith. And you can see it's an indicator that probably we may actually not receive this money. Why are we thinking we shall receive it in good faith? AMBA has recognized the receivable for the 10 million potential proceeds and has credited property, plant and equipment. All right. So December 20X8, I'm thinking of impairment, and then they, because of the storm, we have an event after reporting period. So let's first talk about the 20X7 and how we are going to account for our warehouse. So what could the student then be expected to write, having known all that? Now, events after reporting period. So I could say the storm occurrence on 1st and 2nd Jan 20X8 constitutes an event after reporting date. So it's an event after reporting date. So what happens with that standard? Now, the standard says this event could be categorized as adjusting or non-adjusting. So IAS, can say IAS 37, IAS 10 would categorize this event as a non-adjusting event in as far as this event couldn't have been reasonably predicted as at year end. So year end, which we know our year end is December 20x7. So if it's a non-adjusting event, so thus no adjustments to the December 20x7 accounts are necessary. However, if the damage is considered, so if the damage that has occurred is considered material, if I may say, material, and expected to considerably affect the decisions of the users of the accounts. Who are these users of the accounts? We are speaking of the primary users of the accounts, who are the shareholders, people who put capital into the business. So if the damage is considered material and expected to considerably affect the decision of the users of the accounts, then what happens? Amber will be expected to make disclosures regarding the event. So notice that we are only making disclosures. We are not touching our accounts. We are not making entries into the accounts. So definitely now we know that for the warehouse in December 20x7, we don't have to touch our accounts because this is a non-adjusting event. And on top of that, if it's considered material, and I think it is material because the damage, notice that we are recording a claim of 10 million from the insurance company. The director recorded a claim of 10 million from the insurance company. So it means that probably the damage was massive. The damage was quite material, $10 million. So they're expected to make disclosures, and the disclosures will be relating to the extent of the damage and how this damage is expected to affect our operations going forward. So for 2.5 marks, I think what we have written here will definitely be enough for those marks. Okay, now in December 20x8, how are we going to account for that warehouse? Now, December 20x8 is the subsequent year. Now, here we know that the storm led to structural damages. It led to structural damages, and these are indicators of impairment. These are just indicators of impairment. Now, the moment we notice indicators of impairment, according to IAS 37, we have to do what is called an impairment review to prove that actually there is impairment. So in December 20x8, the storm led to structural damages, and these are indicators of impairment. So we can say IAS 37 requires that an impairment review of the structure be carried out This will entail a comparison between recoverable amount and the carrying value of the structure. Okay, So then we look for the carrying amount. Say once it is confirmed that impairment, that there is an impairment, then the structure will need to be written down to the lower of carrying amount and recoverable amount. Right. So then we need to check. We have some entries. So since we are looking at how we are going to account for the warehouse in the accounts of December 20X8, then we are thinking, what are we supposed to account for? How are we going to account for this? We have to check where these entries are going to affect, because when we are accounting for an item, we are looking at the impact on the statement of financial position, statement of profit and loss, probably statement of cash flow, statement of changes in equity. So any question in strategic business reporting that asks you how maybe a specific item should be accounted for, you're always thinking of those statements and what impact will be there. If you were to get the full marks, you're always thinking, what's the impact on the statement of profit and loss? What's the impact on the statement of financial position? What's the impact on the statement of cash flow? So now that will be very crucial in us getting the full marks. All right, so impairment, which is the first one. So carrying amount, if we are to calculate the carrying amount, we know that the cost that we had initially was 38 million, which we all know. Useful economic life, we all know was, the useful economic life, we know was 40 years. So, and we bought this asset, we started using it on 1st January 20X4. So if we started using it on 1st January 20X4, then we are looking for how much depreciation we shall charge so that we're able to get the carrying amount on 1st Jan 20X8 when the storm occurred. So that carrying amount is the one that we shall compare with the recoverable amount. Okay, so at this point, I'm able to know that my depreciation is going to be 38. The depreciation to that debt is going to be 38 divided by 40. Okay, I could put all that in brackets. And then I'm apply it by how many years? Because I've had it from 1st January 20X4. So January 20X5, January 20X6, January 20X7, and January 20X8. Those are basically 4 years. When I apply that by 4, I should be able to get the depreciation that I'm actually going to charge. Then I'm able to get the carrying amount as the carrying amount to that debt will be the 38 million minus the depreciation that I will have charged. So then I know it's 38 divided by 40 times 4. 38 divided by 40 times 4. Okay, so there we are. So I will have 38 divided by 40, which is the annual depreciation, times 4. So I should be able to get the carrying amount. Then the recoverable amount, could put that side by side. The recoverable amount, and that recoverable amount, I hope they gave it to us. They say the recoverable amount, if you look at this exhibit, they say the recoverable amount was 22 million. That's already given, so we are already lucky, 22 million. Okay, so if I have 38 million, divide by 40, and I multiply that by 4. Okay, so I say 38 minus 3.8. I get 34.2 million, 0.2 million. So I'm comparing that, could give it, I'm comparing that with that and trying to estimate which one is higher. And so we know that IAS 37 says, okay, we know that the standard says the impairment that we are to charge, just sorry about this. This was IAS 36 impairment. All right, IAS 36. So we know that when we look at our carrying value and the recoverable amount, the carrying amount is greater than the recoverable amount. And that's a confirmation that there is impairment. So the process which we have been going through to determine the carrying amount and the recoverable amount is what we call the impairment review. So we are trying to find out, is actually this asset, is it actually impaired? So because the carrying amount is greater than the recoverable amount, then we can say that the asset is impaired. So we say the structure, let's say the structure is impaired based on the review. So then this company is called Amber, will record, so these will be the entries. We'll record the following entries. As at 31st December. So they'll record the following entries as at 31st December 20x8. So in the statement of profit and loss, what are they going to record? They're going to record an impairment expense of, the figure will be the 34.2 minus 22. Okay, that's one. Then they'll also record there the impairment, the depreciation. Also record there the depreciation. The depreciation we calculated, remember, now that the asset was impaired, we got a new value for the asset, and we are going to depreciate it over the remaining useful life, which was revised to 11 years. So now the new value of the asset which we are going to have is going to be 22 years. 22 million, that's the new value of the asset. When I divide it by 11, that will be the depreciation we are going to record for that year, because we are dealing with a specific year, which is 20x8. Then in the statement of financial position, we're going to record our asset. And that asset that we have here is now going to be valued at, at year end, is going to be the 22 minus the depreciation that we shall have charged. Which is 22, divided by 11, which is actually 2 million. Okay, so that will be the value of the asset. All right, so at that point, probably we have done enough to get our 9 marks. Someone would ask for the double entries. If we need the double entries for all this, I could just say journals, just to ensure that we have actually fully used up all the information that we need. So when we are impairing the asset, we debit and credit something. So we know that we are going to credit the asset and debit impairment. So those are the entries. Then the entry may be for the depreciation. Now that we have that for the depreciation, so use debit depreciation expense. And then you're going to credit accumulated depreciation. And there it is. We probably have our 9 marks based on the split. See? Sorry, okay, there's another part asking explain how the insurance claim should be treated in the financial statements of that. Okay, now the insurance claim. As we think of the insurance claim, we are thinking of provisions. We know that provisions move along with contingent assets and contingent liabilities. So when we are expecting money from the insurance company, that sounds like, and that should be a contingent asset if the conditions necessary are met. So this company is expecting to receive insurance money. They're expecting, although if you look at the exhibit, they're expecting it in good faith, and that sounds doubtful. Sounds like they probably know that they are not entitled to this money. And one of the reasons is they insured against general damage, and they deliberately chose not to insure against natural disasters. And we all know that the storm is a natural disaster. Now, if that is the case, then most likely when the insurance company comes, they'll say, no, you actually did not insure against the natural disasters. So we are actually not going to reimburse you money for all the damages that you incurred. Moreover, when we look back on our structure, we notice that the damage that was caused was just aggravated by the storm, but the structures themselves were already damaged. So that could also be an excuse for the insurance company not to pay us because the damages were already there. So it's like we are already at the edge and someone is pushing us to fall into the water. So we have already given them the reason to make it easy, probably to kill us. So when we look at this kind of question and they're asking us how we're going to treat the insurance claim, we're looking at it in the perspective of a contingent asset, and this specific contingent asset, we want to know, should they record it? Because notice that they have already recorded it as a receivable. They already recorded it as a receivable. They are expecting to receive it, but did they make the correct treatment? And so we are going to look at it, and that will be IAS 37, which I was consistently referring to as standard for impairment, just mixed up the IAS 36 and IAS 37. So the IAS 37 provisions. So provisions, contingent assets, and contingent liabilities. All right, now, of course, in the exam, you don't have to list the standards like the way I'm listing them. I am just listing them because to show you that it's the main heading, it's the main issue that I'm going to be talking about in that specific question. So, there it is, the insurance company. We are recording, the company already recorded a contingent asset. Now, we can say that the insurance claim constitutes a contingent asset, constitutes a contingent asset under IAS 37. The standard requires that this is only recognized once AMBA is virtually certain about the asset materializing. So by this we mean how sure are you? You must be virtually certain. And the guidance is for us to be virtually certain, we are probably at the 90 plus percentage. 90 plus, I could say we are the 90 plus percentage. 90 plus percentage that we shall actually receive that money about the asset materializing. So now I'm going to critique what is happening. Now, the insurance company, or we can say Ambaco, deliberately chose not to insure against natural disaster, which forms the basis of the damage for which the claim is being made. So the natural disaster is forming the basis for the damage for which the claim is being made. And we know that we deliberately did not insure against natural disasters. And what does that mean? Amber should not recognize an asset in relation to the damage, in relation to the claim, as they can not be certain about receipt, as they have no reasonable grounds to make or raise a claim. So the insurance claim, that's how it should be treated. We shouldn't recognize an asset in regards to that insurance claim because we didn't insure against natural disasters. And on top of that, we are only expecting them to pay in good faith. So for 9 marks, probably we have written a lot. Key marking points, as you can see. Okay, so there it is. All right. The next question, which is asking us to use Exhibit 2. Next question is asking us to use Exhibit 2. Explain how the lease of the building should be accounted for in accordance with IFRS 16 leases in the financial statements for the year ended, and evaluate how the correct application of IFRS 16 in the financial statements. So there are 2 questions, and they are both going to use Exhibit 2. So here we go. Lease, the lease itself. Amber has decided to lease some of its assets as LSC, which will mean the application of IFRS 16 for the first time in its financial statements for the year ended 31st December 20X7. At 1st January 20X7, Amber entered a lease agreement for a building. Okay, the date is extremely important. We don't want to leave out those dates. Okay, they entered into a lease agreement for a building with both the lease term and the remaining useful life of 10 years. With both the lease term and the remaining useful life of 10 years. So, okay, so the lease term and the useful life is 10 years. Good to know that. The present value, okay, of the lease payments. Present value of the lease payments as at the date when we got into the lease was 54 million. Key information that I could highlight. The lease payments of 6.7 million made on 31st December. Okay, lease payments that had been made was 6.75 million. Okay, that's what we made on 31st December 20x7. Was recognized as an expense in the operating category of the statement of profit and loss. We need to maybe think about, is that a correct treatment? There was no recognition of the right of use asset in the statement of financial position. The lease has an implicit rate of 4% at December, so the implicit rate is 4%. Okay. On 31st December 20x7, before applying IFRS 16, the equity and debt were 470. Okay, this information we shall use in the next part. Could highlight it just so we know. All right, so what we have seen in summary is we got into the lease on 1st January 20x7. The lease period is 10 years. They have given us the present value of the lease payments. We made a 6.7 million payment. I mean, we received the 6.7 million. Okay, we are the lessee, so we made the payment. And then they have given us all information related to the lease. But first, crucially important is for us to know about IFRS 16. So key things to note as we start to do this question. IFRS 16, we know that under IFRS 16, what do we need to know? The moment we get into a lease contract, IFRS 16 requires us to recognize a right of use asset and a lease liability. Now, the lease liability is recognized at the present value of the future lease payments, and the right of use asset usually correspondingly takes on that value, except sometimes when we have probably advance payments, we have other issues affecting our right of use asset. But under normal circumstances, it would be recognizing a right of use asset and a lease liability at the present value of the future cash flows. So we need to talk about that initial recognition, and then subsequently the right of use asset is an asset and therefore is depreciated over the lower of useful economic life and the lease period. Then the lease liability is amortized. The lease liability is amortized. So what happened with this company is when they got into the lease, they simply just expensed the payment that they made. So the exception to IFRS 16 only goes for low value assets and for lease periods that are less than 12 months. So for low value assets, what you do is when you lease a low value asset, any lease payments that you make will go straight to profit and loss. And for lease periods that are also less than 12 months, we still just recognize the lease payments in the statement of profit and loss. Now, what happened was, here when we made the lease payment, you notice that we just expensed it to the profit and loss. Now, there are two types of leases that we are looking at here. We have what is called an operating lease and a financing lease. Now, in the operating lease, they would be very right for them to expense, but in the financing lease, then we have to apply the IFRS 16 and have to do the lease accounting that we are basically going to talk about here. So now this kind of lease that we got into, we can't say that this is an operating lease in as far as the lease period is greater than 12 months. So they were wrong to recognize this payment as an expense in the statement of profit and loss. So we know that that's already a mistake. So let's see, because we are in a financing lease, and the financing lease, it's how we are going to account for this specific transaction where we are going to recognize a right of use asset and a lease liability. Okay, now explain how the lease of the building should be accounted for in accordance to IFRS 16 leases in the financial statements for the year ended. So they are speaking about how we are going to account. Now, if they are speaking about how we are going to account, just to remind you, we said if we are dealing with accounting, then we are looking at the different financial statements. what goes to statement of profit and loss, what goes to statement of financial position, what goes to statement of cash flows. All right, so IFRS 16 requires that okay, we can say ABACO, we could start with that, say ABACO entered into a financing lease contract. And we can say IFRS 16 requires that ABACO accounts for the lease by recognizing a right of use asset and a lease liability and a corresponding lease liability. So now we are recognizing the corresponding lease liability, and this is at the present value of future lease payments, which was already given to us. So that's it. So we can say we shall have debit and credit. So we shall debit right of use asset, and then we shall credit here lease liability. Lease liability, we said, is at the present value of future payments. Okay, so that's the initial recognition. So when we got into a financing lease, that's what was required of us. So you could find the student having to write here. So subsequently, what will be required of us? Subsequently, the right of use asset will be depreciated. Over the lower, but in this case, both the useful economic life and the lease period are the same, but the standard requires that we depreciate over the lower of the useful economic life and lease period. And the simple explanation is, if I get into a contract, this contract, and I'm having the use of this asset for 10 years, but its useful economic life is 7 years, then it wouldn't make sense that I depreciate over 10 years because the useful economic life is less than the lease period. And then likewise, if the lease period is 7 years and the useful economic life of the asset is 10 years, you always choose the lower, because the lower is the period over which you'll get economic benefits from that asset. So we shall always use the lower of the useful economic life and the lease period. Then the lease liability. The lease liability, we know that it will be amortized. And when we are amortizing, we are using the rate implicit in the lease. So in the financial statements, at the end of 31st December 20X7, that's how it will be. Now, we may find ourselves having to do the calculations for that in order for us to apply that. And we can say, okay, so I can put here the calculations. So here the right of use asset will have been recognized at 54 million. And then the lease liability, 54 million. Don't forget that that was the present value of the future lease payments. subsequently when we depreciate the right of use asset. So then we shall have statement of profit and loss, and then we shall have the statement of financial position. The statement of profit and loss will have the depreciation, okay, and then it will have the finance costs. Now, with effect from September 2025, IFRS 18 requires us to basically tell us where these are going to be charged in the statement of profit and loss. Now, notice that this is a financing lease, so it's already indicative of where in the profit and loss we are going to charge these items. So it would be good for a student to go ahead and tell the examiner that, oh, we are going to charge this depreciation, this finance cost under the financing section. Why? Because this is a finance lease. So the depreciation that we shall have will have been calculated as follows. We shall have the 54 divided by the lower. We know that it was 10 years. Okay. So for that specific year, we shall have the figure for the depreciation. And then the finance costs, those ones will be calculated as we amortize. And then we have also here the statement of cash flow. The cash flow statement. Oh, what is going to happen in the cash flow statement? The money that we actually paid. Under the cash flow statement, we could say here, under the financing section, okay, statement of cash flow, financing section. So subsequently, the right of use asset we have said will be depreciated, and then the lease liability. So the depreciation for the asset, statement of profit and loss, that's what we shall have. Those are the entries that we shall have there. Entries for the statement of cash flows and the statement of financial position. Okay. So the lease liability will be amortized. I could get this and probably paste it there. Okay. So in the statement of financial position, we are definitely going to have the liability, year-end liability. Sometimes the examiner might want you to split it between the current and non-current liability, but we shall have the year-end liability. Then we have some money that we paid. The money that we paid doesn't go to statement of profit and loss under this lease, this lease accounting. It goes to statement of cash flow. What goes to statement of profit and loss is the finance costs that we have calculated as we amortize the lease liability. The money itself that we pay, the cash itself that we pay, will go to the statement of cash flow under the investing section. I can say the investing section, and then I said there, under the investing section, we shall have the cash paid. The cash paid. And that was the 6.75 million. Just to remind you, it's that figure that I'm talking about. It's that figure that I'm talking about, 6.75. So the lease payment that we made. So then we have to do the amortization itself and see how it works. The amortization itself isn't that complicated. I could put here a table. I could say I want that so that can have the opening year, then the interest, cash, and the closing balance. So I could say, okay, Let's delete the table. So make it a little bigger. So because I know I need the opening year, the interest, the cash paid, and the closing balance, could probably do that. So opening balance, and then here I say the interest, and then here the cash that we actually pay, and then here the closing balance. So then I say the opening balance was actually 54 million. Then the interest, now the interest that we are talking about here is the finance cost, and we are using the rate implicit in the lease. And the cash that we pay, then the closing balance. Now the good thing with the cash, it will always be constant. 6.75, 6.75. I don't really need to amortize for so many years. And then the interest is calculated based on the opening balance, which will be the 54 million times 4%. That will be the interest. And that gives me a figure of 2.16. 2.16. Now this interest is what I called the finance costs. There we are. And okay, so closing balance will be 49.41, I guess. So with amortization, there's no need to really think so much about it. What happens is you started off with the 54 million. It grows by the finance cost or the rate implicit in the lease. Then you pay off cash. When you pay off cash, it reduces, and then you have your closing balance as that. So the cycle repeats, the 49.41 million. Then the finance cost will be calculated based on that. 49.41 times the 4%. And then we pay off cash. This is the cash. And then we get our closing balance as figure of 44.64. Now notice that all these figures are in millions. I could put here millions so that we don't have. So if you decide to use millions, keep it at that 1.98 millions. So now the first line represents the year ended 31st December 20x7. Second line represents the following year, so like that. And so the figure they want for the liability, total figure will actually be the 49 point something. That's the liability figure as at year end, 49.41. Sometimes the examiner might want you to split it between current and non-current, but even if you gave that as your answer, I'm sure that would do. So there it is. So we calculated the finance cost that goes to statement of profit and loss that we had here. The finance cost here is a figure of 2.16 million. The depreciation that we had calculated is a figure of 5.4 million. So basically, that's what is required of us. Hope we have answered it. Saying explain the lease, the financial statements for the year ended, and Amber. Okay, so that is it. Then they are asking us to explain, evaluate how the correct application of IFRS 16 in Amberco's financial statements will impact the gearing ratio. Gearing, they have also given us the calculation, the formula to use. Gearing, which shows the indebtedness of a company. is debt. They've told us to use debt over equity. All right, so then when we think about that formula, we need to know, since they want us to evaluate the impact of using IFRS 16, then we have to come here and check. So they said at 31st December 20x7, which is at that point, what happened? Before applying IFRS 16, the equity and debt of Amber were 470 million. That's the equity, and the debt was 168. So the first question would be, what was our gearing before? So I could say here, before IFRS 16, our gearing was, before IFRS 16, the gearing was 168 divided by 470, and we can comfortably say that it was at 35.7%. 0.7%. That was the gearing before, and then after, after the application of IFRS 16, what did our gearing become? The gearing became, so we have to be very careful, because now, because of the application of IFRS 16, remember initially when we hadn't applied IFRS 16, what we did was we were just expensing our payments. We did not recognize a right of use asset and a lease liability, just like it was said in this exhibit. So we didn't recognize a right of use asset. So they said there was no recognition of right of use asset. Okay, so because there was no recognition of right of use asset in the statement of financial position and no corresponding lease liability, we definitely did not have a liability on our books. Now, when we applied IFRS 16, we recognized a right of use asset and a lease liability. So what's going to happen is our debt is going to increase. It's debt over equity. So the debt, which was initially 168 just, is now going to increase to a figure of, since they are speaking of 31st December 20x7, we are having 49.41 as the lease liability. Okay. Then we are dividing it by the equity, debt over equity, and we are sure the equity element is actually going to remain the same, which will be a figure of which was given as 470. It was given as 470. Now, you have to be very careful as you're looking at that equity element, because when you look at that equity element, when we charged the finance cost, the statement of profit and loss, the finance costs went under the financing section, and of course that had an impact on our profit figure that we recognized. We know that that will effectively trickle down to the statement of financial position under the equity section, specifically under the retained earnings, because we know the profits we make will always go to the retained earnings. So when we are calculating our gearing, the assumption is the finance costs that we took to the statement of profit and loss, which was a figure of 2.16. So that affected our profit and loss. And when we are calculating our profit and loss, we are always looking at the final figure, which is the profit figure. And that profit figure will finally go to the equity section and the retained earnings, like I have said. The detail here, the more, we can say, more complicated issue here could be when that finance cost trickles down to the statement of financial position, the impact will be on the cost itself. In case the cost is tax allowable, the net effect is actually what will go to the statement of financial position to affect our retained earnings. But at the moment, I can take it at a simplistic view of it and say, just consider that and say our new gearing is going to be 45.2%. And there it is. So when we are comparing both figures, the 45.2 and the 35.7, we are seeing that actually our gearing has increased as a result of us applying IFRS 16. So, what information can we actually write about this? What information can we write about it? We have calculated and have noticed that the gearing has actually increased. So we can say that on application of IFRS 16, what happened when we apply IFRS 16? This meant capitalization of the lease obligation at the present value of future lease payments. This liability increased, so the liability that we recorded increased, the debt structure of Ambaco. The corresponding effect on the equity is an indirect increase as profits upon which finance costs charged to profit and loss have an impact. So the corresponding effect on the equity is an indirect increase as profits upon which finance costs were charged, upon which finance costs charged to profit and loss have an impact, ended up in the retained earnings. So here what we are trying to say is when we recognize the lease liability, of course the liabilities of our company increased. So the debt structure, there was an increase in the debt structure of Ambaco. Now the corresponding effect on the equity, because we know we are calculating our gearing based on debt out of equity. So the corresponding effect on the equity is that there's an indirect increase in as far as the finance costs that were charged were tax allowable. So there's an increase in the profits which end up trickling into the retained earnings in the statement of financial position. So however, the increase in the debt outweighs the increase in equity, which led to increase in gearing, increase in the gearing as assessed above. So that's the impact it has, and we can comfortably say we have we're working out of 11 marks for this. Pretty good, since we have shown the entries. Probably you could put in some double entries where the double entries for this finance cost, depreciation, lease liability. So basically we have the 11 marks at that point, most likely. Okay, and then finally for 5 marks, we have this part of the question that wants us to explain how the purchase of machinery in exchange for Abacus equity shares should be accounted for in the financial statements for the year ended. And that is, we are going to use Exhibit 3. So using Exhibit 3, what happened? On 1st July 2007, Abacus purchased machinery with a list price of 2 million. So we purchased the machinery with a list price of 2 million. The supplier accepted payment in the form of equity. So we actually are going to pay for this machinery by issuing 600,000 shares. The shares have a value of $1. The share price on 1st January 2007 was $3. So the first one was the nominal value of the shares, which was $1. But the share price, we know that that's the nominal at which they are issued. But the fair value of the shares on the date when we purchased the machinery is $3. By 31st December, which is our reporting date, the share price had risen to $3.2. The useful life of machinery was estimated to be 5 years at 1st July 2007. Okay, so they want us to account again, explain how the purchase of the machinery should be accounted for in the financial statements. All right, now, question would be, at what value are we going to recognize our asset in the books of accounts? Now, since we are looking for how we are going to account for this, we are still looking at financial statements. What goes to statement of profit and loss? What goes to statement of financial position? What goes to statement of cash flow? That's where our marks will be. Okay. Now, the transaction or purchase of the machinery was a non-cash transaction whose consideration was settled in shares/equity. Okay, now I'm going to explain this using a double entry and how this needs to be remembered always. So they told us that the list price based on this exhibit, could open the exhibit, they said the list price was 2 million. Now it's 2 million, and when we look at the date when we purchased, they're telling us that the share price was actually $3. $3 was the share price. That's how much we bought it. Now the question would be, are we looking at the list price of the asset, or are we looking at the fair value of the shares? Because we know how many shares we are actually going to issue. And if it turns out that the list price is different from the valuation of our shares, then we are always going to record this machine that we purchased always at the fair value, because it's indicative of what value we are actually attaching to this machine. So using double entries, this is how I'm going to record it. This is how I'm going to record this transaction, well knowing that I'll always be looking at the fair value of whatever I have purchased. So as I am buying this machinery, I'll have a debit and a credit. I'll debit my asset and then I'll credit my share capital. Okay. And where is this coming from? The fact that I'm going to issue shares. The fact that I'm going to issue shares, then of course the share capital has to be affected. The share capital value has to be affected. And the question is, how many shares am I issuing? I'm going to issue 600,000 shares. Okay, now since you're issuing 600,000 shares, we need a monetary figure. And when we are looking at those shares, they should always be at their fair value. And the fair value at the date of purchase was $3. Now those will give me a figure of 1.8 million. That will be the impact on the shares that I'll actually issue. That will be the impact. Okay, now when it comes to the asset, I'm going to list it at I'm going to record it at the list price, which was actually 2 million. So when I actually purchase this machinery, I am recording it at its list price while looking at the share capital at its fair value. Now the implication is, if you look at that double entry, of course it is not balancing. Of course that transaction is not balancing, and it might not balance in two ways. In this case, the asset is having a bigger figure compared to the share capital that I've recorded. In another instance, it might be the reverse. You might find yourself when you record the list price of the asset versus the share capital, and you find maybe that the share capital is higher than the asset itself. Now in this scenario, if that's the transaction that I have recorded based on those figures, then I know that I need another credit, and that credit will go to share premium. We'll go to share premium, and that will be a figure of 0.2 million when we are recording that asset. So that's how this should be accounted for. Now notice that this is the entry that I'll make on 1st July, the date when I purchased this asset. This will be the entry that I'll make. So I could say here 1st July 20x 7. That's the entry that I'll make. Then notice that the figure we want, since they want us to account on 31st December 20x7, what will have happened? First, the asset will have been depreciated. The asset, which was recorded at a figure of 2 million, will have been depreciated. And when I speak of depreciated, I'm speaking of statement of profit and loss. They say the asset had an estimated useful life of 5 years. So divide by 5, but since I bought it halfway there, so meaning I held it for only 6 months. So I could multiply this by 6, divide by 12. That will be the depreciation to charge in the statement of profit and loss. And so, looking at it, I can comfortably say that the asset will be 2 million minus the depreciation that I've probably calculated, which is the 2 million divided by 5, and half of that becomes 200,000. So 0.2 million, which will give me a figure of 1.8 million. So statement of financial position, and then statement of profit or loss. So those will be the entries in those correspond. If you wanted to put their double entries, here you would credit the asset and then debit depreciation, something like that. Okay, so basically that's what it would be, and this will conclude our discussion of this question number 4. Thank you for listening.